Okay, great to have you here today. My name is Josh Horn, and this is Business Valuation and Shareholder Disputes. The audience is designed for attorneys. Other people, of course, are welcome to attend today. I've had some success in this area following the framework I'm going to show you today. There are many different directions this can go. This is the way I found to be one of the best ways to go through the problem and have the best chance at solving it. There's not a lot of math in this, very little math, so don't get intimidated by the numbers or anything. I've got a couple of slides with math, but I'll walk you through it. It's not difficult. Really, what I'm trying to do is take you from the point at which you, as the attorney, calls me. How do you get started? Should you even get started? What are the steps and what are the pitfalls to avoid? What are the places where you can improve your chances for success for your client? Put them on the best path. So let's get right into it. I'm not going to spend much time on my bio. I've put this out all over the place. I do work in this area for shareholder disputes and litigation related estate and gift and M&A work. There are a lot of other reasons to get a business value, and I generally refer a lot of that outside that area of my expertise. So let's go through the agenda. Again, it's real straightforward. 3 questions you must ask. I found that these are critical to understand where to go in this area. And I'm going to explain why in just a few moments. Leave you in suspense on that just a few more moments. When to walk away from this, if at all possible. If you have an opportunity as the attorney or as the client to say, okay, based on the answers to the 3 questions, should I walk away if possible? When to move forward? The answers, of course, would be different to those questions typically. How to estimate value without going all in. And what I mean here is a report for court and testimony, business valuation for settlement, as I would suggest it be done, business valuation for court, a simple flow chart for decisions, which basically summarizes the bullet points above, landmines and worst case scenarios. Okay, let's get right to it. When an attorney calls me, this is the question that I feel like they're really asking me. Is the juice worth the squeeze? I think this is kind of encompasses what they are asking me typically. Should we proceed? Should we invest time and money and effort into this? Should we hire you, Josh, or some other expert? Should we do anything with this? We have this case on our desk. Does it make sense to proceed? And so, at the risk of answering a question with a question, which I hate to do, I think that these 3 questions will help you answer that question. And they're real simple questions. I'm going to go through them one by one. And there is a certain amount of expertise required, I think, to answer the questions, but I'm giving you the guideposts for how I solve them. Really, the answer to the 3 questions in terms of the value that, pardon the pun, that I could provide to you are, does the business have value or not? And that's really what we're trying to solve. It can't be answered with a simple phone call, but with a little analysis around the 3 questions, it can be answered. Business or job? This one I think is often easily overlooked. I've had some of these cross my desk over the last several years, and you don't want to skip this step, in my opinion, because a job is not something that you would typically value in a shareholder dispute. There isn't a bright line test for how this is analyzed. It's not, if I answer this and this, it's definitely this. It's definitely a judgment call, but there are some clues I think that can be followed that can let you avoid some headaches from pursuing something that's more a job than a business. First one I would say, are there workers besides the owners? If you pull the workers out, are they basically, are the owners the only people putting labor into this business? You say, for example, let's make a simple one. Two of them, they're both shareholders. You put them into the business, they do all the work. If you pull them out, does the business still exist? That's one potential test. It's not a pass fail, but that's one question to ask. Could it be sold? Is there any market interest in this? Are there any potential buyers for this activity? And you might refer to it as an activity until you really flip the switch and say, okay, I definitely know it's a business. I hesitate to put, and I didn't write this on the slide intentionally. One thing to keep in mind is the top line sales can definitely be an indicator of whether it's a business or a job, but keep in mind that I've seen businesses with a few $100,000 in sales, a relatively small business that is super profitable, and one with tens of millions, and it's hemorrhaging money and it's losing tons of money. So be careful with that one. Just as a general rule, it could come into play, but I'm going to push that one kind of down the line a little bit. Possible jobs include things like lawn mowing, daycare, childcare, however you want to call it, delivery routes. These are just a few things I've seen that are potentially more jobs than businesses. If it's more a job than a business, litigation just may not make sense. And again, feel free to lean on me if this is not an area of your expertise, because this is something that is again, it's a judgment call. If it's a business, let's go to the next question. Cash flow. And what we're talking about here, what I'm talking about here is positive cash flow. Can the business generate cash flow? This is one of the most important numbers in business valuation. I can't stress that enough. It's the numerator in the income approach and what we call the parameter in the market approach. And this is not some kind of a trick. It's usually nowhere on the tax returns of the financial statements. Even if you're lucky enough to get financial statements, a lot of times they, under allowable exceptions, they're able to omit the statement of cash flows. So it needs to be calculated by somebody who knows how to do it. It's the interaction of the P&L or the income statement and the balance sheet. And typically cash flow is lower. Often it's lower than profit because there are things on the balance sheet that must be accounted for that can reduce the cash flow typically. So for example, debt service principal could reduce the available cash flow, but that's not included in the profit of the business. So let's look at an example of this. And again, this is one of the only number examples. Don't get too hung up on the numbers. I'm going to try to basically point you exactly where you need to pay attention and why this matters. What I want to stress here is cash flow is easy, right? That's sarcasm, because it really isn't. I've been doing this since 2008, and a tax return or a financial statement that just lands on your desk and you just say, okay, this business is profitable and generating positive cash flow or not, is not something that you can typically do in just a few minutes. It likely can take longer than that to really understand what's happening with the business. So what I have up here is the same company under two scenarios, and they made one different decision, and that is all. And so I'm going to show you why scenario 2 is different than scenario 1. Here's something that I do want to draw some attention to. So the taxable income is almost the same. It's only $40,000 different. And where that's really important, a couple of reasons. I think most of us would not consider $40,000 in difference in taxable income to have a huge impact, relatively speaking, here on the value of the business, especially, like I said, comparatively. And in an S corp or partnership situation, a pass through, as we like to call it, that might be the stopping point at which you get information. You're not going to have this information below readily available and in front of you. So that's essentially, you're going to see taxable income. And I don't think many of us, myself included, would see those comparatively and say there's a big difference between those two numbers. However, in scenario two, they made one different decision, and the difference in the cash flow at the bottom was almost $1 million. Big difference. And it goes negative in scenario two. So to give away for the people that aren't super fast in figuring this out, the difference is the payment in long-term debt. They paid an additional $1 million. Let me just get your eyes to it right here. So they paid an additional $1 million on the long-term debt, which reduced their interest expense. So why does this matter? I mean, why should we even care here? That's historic. And what we are really aiming at in most cases are future looking. That historic may be relevant, but maybe not. So what we want to do is focus on what the normalized future looking cash flow of this business should be. And that's going to take some further analysis. And really, in some cases, the business, maybe in a historic last year, 2024, they didn't produce cash flow, but could it under different circumstances? We may need to adjust the historic sales, expenses, assets, liabilities, equity to project future potentially. I alluded to pass-throughs before. It's understand that they typically do not pay, well, they usually always don't pay federal income taxes. And then there may be some state income taxes. But the thing about it is we may need to impute income taxes because they will be paid by the shareholders on their personal income tax return. So we can't pretend like they don't exist in most cases. Is the business operating at arm's length? Are there family members involved? Are there other related parties? And so that's a question we might ask. Is the business operating its transactions at arm's length? Are there owner wages above or below fair market value? Is a rent expense above or below fair market value? These are questions we might ask in certain circumstances, maybe not all. It's pretty common that the owner of the operating business that we might value also owns the real estate. And so a common legal technique employed is for the operating business to pay out rent to the owner of the real estate that is also a shareholder in the business. So it's common, but it is also, unfortunately, just know that it's very common in my experience that rent is not fair market value. It's not always nefarious, but it may be a long time since they had an appraisal done. So it may be necessary to dig into whether that rent being paid out of that operating business is fair market value, depending on the circumstances. Are there personal expenses in the business? Another question we might ask. Are the records complete? Something I've said for years is you cannot get accuracy without completeness. If you were to phone me and call me about a case like that and say, well, we have reason to believe that there are 3 bank accounts, but they're only filing tax returns and financial statements, which include 2 of them. It's very unlikely that that's going to be an accurate financial statement or tax return if there's a whole nother bank account that's not included, which Gets into a much broader topic that we're not going to go down this road today, forensic accounting, which could include basic procedures up to very advanced ones to establishing what the real cash flow of the business is. So just understand multiple professional judgments may be required to estimate what cash flow could be. Why does this matter? And the Grand Canyon picture is here because of the potential Grand Canyon gap based on how these calculations work. Now, don't use these numbers. They're generalized, but they do illustrate the point that incremental cash flow changes can have a huge effect on the value of the business. And so the cap rate is just, again, a risk rate I've thrown in for illustration purposes. It could be different. It's a risk rate. It could be very different in the case that you have in front of you right now. So I'm just dividing the cash flow by the cap rate. And as we move from $100,000 cash flow and a 15% cap rate, which I've kept the same throughout, the cap rate all throughout, we move up to a $3.3 million potential value as we go from 100 grand to 500 grand. So this is critically important because especially if you're working under the assumption that the business is generating 100,000, but a normalized level of cash flow is 500, or vice versa. You're thinking it's 500 and it's actually 100 after the tires are kicked and more analysis is done. So there's obviously a lot more at stake when the business could be worth 3.3 million instead of 667,000. If it is negative, our expectation that cash flow is negative or it can't be positive at this point in time, let's go to the last question. Are the assets greater than the liabilities? I think my experience is a lot of attorneys and business owners, this is not a disparaging comment, but I have a lot of them go, okay, we'll take the assets less the liabilities, and that's the value of the company. And that is one way to value the business, but that is typically the floor value of the business or the lowest it could be. In most cases, if you employ an income, a market, and an asset approach, typically the income on the market will be somewhere here, and then the asset will be below it here, and that incremental, that difference between them will be an estimate of the goodwill or intangible value of the business. Goodwill is not unicorns and pixie dust. It is a number we can quantify. And it is rare when you have a profitable cash flow generating business, pretty rare in my experience, that your asset approach is not below your income and market approach. And those approaches basically incorporate the goodwill piece, an intangible piece. However, we are at this point in our decision tree because the business can't produce cash flow. So this is important to understand. The goodwill and intangible is pretty much non-applicable in this, if we are in this point in time. However, if I'm working with you, you say, Josh, let's figure out what the floor value of this business is. I've often referred to this, and this is not a technical term, just to give you a concept to think of in your mind. I've often referred to this as walkaway value. So if I just handed you the keys to the business, you got the bank account, you got the trucks, you got it, and then you paid off all the liabilities, basically you liquidated it, what would be left? That is, just to re-stress this, that's typically rock bottom. That's where we're at with this because we don't think that business can generate any cash flow. You come to me and say, let's do that so we can figure out the lowest value, or basically this asset value. And then I would say, if you ask for my advice, you would typically need to hire asset appraisers for the pieces that I couldn't handle. For example, the equipment, real estate, anything that I don't have specific expertise in. Very uncommon that an asset appraiser also values businesses and vice versa. So we would use those. I would use those in my business valuation using the asset approach if you hired me to do that. So that's how that would typically work. If the answer to this is no after no cash flow, the business likely has no value. All right. I want you to kind of pause on that in just a moment, because there's very little chance, if we've done some analysis, if we've done enough analysis, there's very little chance the business has value. And that also means that that shareholder's interest probably doesn't have value either if we've reached this point in the decision tree. Okay, so to recap this, my advice here to the attorney: when to walk away, if you have that option, is if it's a job. All right. And again, that's a judgment call. I would consider stopping, settling if it really looks like more of a job than a business. If it's a business, but cash flow unlikely and the assets are less than the liabilities, that means it's probably a business that has no value. When to move forward: it's a business, it has cash flow, and or the assets are greater than the liabilities. So that's a pretty succinct way to look at this. It does involve some analysis and some judgments on the front end, but it gets you to a place where I think you can make a solid decision. That's a business that probably has value. Now, how can we estimate value without going all in? I want to preface this by saying the business valuation standards I'm going to reference here today, not to exclude any valuation organizations, they're from NACVA. The NACVA standards are similar to AICPA standards and ASA standards. So those do align. I would encourage you to use someone that has professional standards and follows them if at all possible, because they do, in my opinion, help you prepare better reports for your clients and keep you on the right path. So what I suggest, if negotiation, if settlement is in the cards, that you consider a calculation report for settlement. And this is what it's defined as. It's when the client, i.e., it could be you as the attorney acting as representative for a business owner that's a shareholder in the business, and the member, that is me or another expert, agree to specific valuation approaches, methods, and the extent of selected procedures. Okay, so we're going to basically agree on a set of parameters. We're going to limit the scope of what we're going to produce, and it's going to produce this calculated value. I find these to be valuable. We're not going to turn over every rock. We're not going to do everything. I'm going to go into later what we would need to do if we're going to go to court. This is a good starting point in a lot of cases, in my opinion. The goal here is settlement. Now, these are the rough procedures. Valuation analyst, meaning me, I agree with the client to limit the scope and prepare a report that could be written or oral. You may often prefer that it be oral on Zoom screen share or in your office on the laptop. That's fine. So let me give you a few examples of how the language is worded under income approach, market approach, and asset approach. So I'm not going to deep dive these because I got to keep you on time. If you want to dig deeper into them, I'm be happy to do that. But what I like to do whenever possible is create what I like to call the three-legged stool around the income, asset, and market approach so that it is as stable as possible. Whenever I can get enough data to be able to do that, I like to be able to do that in a calculation and certainly in a conclusion as well. So just to push in on this for the non-business valuation people, this is less than a conclusion report. I'm going to dig into what the conclusion report, which I suggest is what you use for court, and I'm going to get into the reasons for that later. But again, this can be very powerful at solving problems, especially when you're bumping up against budgetary limitations of the clients. You want to solve the problem. How can you get it solved without spending a ton of money on court and experts and all these kinds of things? I find this can be a really reasonable place to start. Using a calculation to drive this home, you should understand the limitations up front. And I'm going to go into the places where the things that we do in conclusion reports that would not be included here in a moment. If at all possible, you want to try to protect this from discovery because a full scope engagement could result in a different value later. And it's not because of anything nefarious. It could just be, okay, I'll give you an obvious example from one I see all the time. In a calculation engagement, it's going to be rare that I ask about customer concentrations. So for example, in a conclusion environment, if I'm going to prepare a report, I'm going to say, okay, show me the sales by customer. And if I see 80% of the sales or 90% of the sales, I'm just using an example, are from one customer, well, I might say that that's a lot riskier valuation, a lot riskier interest in that business than I would say under a calculation environment where I wouldn't have even asked for that information. Okay, so that's one example. Because that one customer, if they bolt, well, then that business could be bankrupt and gone. Okay, so that's just one obvious example of something that can come up that would not be known early on before that information is obtained, if it is obtained at all. If the case is settled, then maybe that information isn't requested. So again, at your office or Zoom screen share is likely preferable because of the potential discovery issue down the line. This allows you to negotiate with the other side using real numbers. And if it fails, you'll have to decide as the attorney if you want to go to court. Now let's talk about business valuation for court. And again, these are my opinions. There are some varying opinions out there. I think I'm going to present a strong case for why I think this is the way you should approach it, what you should do in terms of what you should have, especially on my end, what I should have in my file, what your expert should have in their file from a business valuation standpoint if you are heading into court and you expect your expert to testify. This is straight from our standards, and it's almost also verbatim from Revenue Ruling 5960. I'm not going to go through every one of these in great detail, but I did highlight the areas where I would definitely want, and you would definitely want your expert to have these in their file. We do have a litigation reporting exception in our standards. So if you hired me and you said, Josh, I need a conclusion, but this judge is going to expect a 10-page report or maybe even a 2-page report maximum. They don't want the 100-page narrative report. I could say, okay, I can deliver that to you. I need to have all this information, though, on this page, at least in my file, however, because they could ask for my file. And the last thing you want is to look really bad, look like I didn't do all the work I needed to do to establish the conclusion that I put out there to the court. And so it's important to understand this information should be in the file at a minimum or in the report if a long narrative report is ultimately what you need. So just broadly, the nature of the business and its history. How did we get to where we are today? How did the business reach this point in time today? I've used the example, the About Us page or, on their website, or sometimes I've used the posters on the wall and you walk in. I've been lucky enough a few times to see those. You can see, yeah, in 1990, we started in a garage and, we elevated our sales to 10 million and you can kind of see the evolution of time and products and services and customers. Those are great things to have to establish this. We want to understand the economy and the industry and how they relate to this particular subject interest. The next three bullets are largely around financial analysis. And most importantly, how does that affect the forward-looking estimate of the value of the company? Is it performing well or below the industry? Is it strong or weak on its balance sheet? Those kinds of things. That's what we're looking at there, summarized in those next three bullet points: adjusted book value, earning capacity, and dividend paying capacity. I already talked about goodwill a little bit and intangible value. I'm not going to talk about that twice. Prior sales of interest in the business. This could be, I always ask for this. One thing I do see, unfortunately, often is that clients do sometimes lose these records, but it is a good idea to ask for it because it can be an indicator of owners, basically former owners coming out of the business and what they were paid out for their interests. It could be an indicator of the value of the company. The business may be worth more or less than it was at those times, but you don't want to be caught flat-footed, if at all possible, in court and not know that those transactions took place. So I always ask for them, and hopefully your clients have maintained those. If not, you'll have to sort of think on your feet at that time if it's a surprise for some reason. The size of the interest, and really what I'm talking about here are control is generally greater than 50% ownership, right? I think we all typically agree on that. At 50% or below, we're either deadlocked or less than control. Deadlocked is effectively kind of less than control too. So that's the way I talk about control. And then liquidity and or marketability is the ability, bigger topic than today, how long it could take to turn that interest into cash. Market price of interest engaged in the same or similar line of business. This is generally the market approach. I'm definitely going to look for these in the databases. Usually they're going to be either private transaction databases or public company or both, depending on the circumstances. Pull those and use those in the report whenever possible, because that gives you a good indication of what are these interests buying and selling for by similar industry buyers. And of course, those could need adjusted for differences and risk, growth, cash flows, and things like that. Hypothetical conditions, and then all other information deemed to be relevant. So that's conclusion in a nutshell. There are more areas where I could dig into this, but you definitely don't want to be in a situation where this information has not been put in the file of the expert if you go into court, in my opinion. So this is the flow chart that summarizes everything up to this point. It may take a minute for your eyes to adjust, but it really isn't too bad. Really at the top, we're just establishing whether this is a job or a business. If it's a job, we're going left and we're saying, okay, let's try to settle this. It's not a shareholder dispute worthy engagement. If it's not a job, we're moving right and we're asking about cash flow. If that's a yes, we're going down to the middle part here, and the business probably has value. If, on the other hand, the cash flow is no, we're going to ask the follow-up question whether the assets are greater than liabilities. If that's another no, we're looking at probably trying to settle this because the business probably has no value. If the assets are greater than the liabilities here, we think that it probably has value. And in the first approach is probably to consider a calculation for settlement. That's an option. And then if that doesn't work, we can go to court with a conclusion. Landmines. And this is all perspective based. Your perspective is likely different from mine. These are some of the things that I would caution you to watch out for and or avoid. And I am not going to opine on the law, and I'm trying to do everything I can to avoid any legal advice here. These are largely valuation related issues that I see could cause you to blow up. First one is calculation in court. Is that a good idea or a bad idea? This is straight from our professional standards, and I've highlighted some things again here. The key thing is that right in the NACVA professional standards is a passage that says this calculation engagement did not include all the procedures required for a conclusion of value. Had a conclusion of value been determined, the results may have been different. Even with the litigation reporting exception, a smart attorney is going to pull my standards or the standards of the expert you hire, and if you're in court and they show this to you, it could be a rough day. And so you don't want to be in that position, in my opinion, where you have to try to defend this in a courtroom setting. It is a limited scope engagement by design, still very helpful for settlement, in my opinion. But we've done less work than a conclusion. So you likely do not want to go to court with the results may have been different, because that's straight out of the professional standards. The expert could be disqualified, and saying the client's budget wasn't high enough is unlikely to be a good excuse. It's probably really problematic at that point. So if you're going to go down this road, understand the risks. I do not testify to calculations currently. There may be others that do, and that's their prerogative, but these are the reasons why I don't. All right. Let's talk about when settling isn't an option, which some of you may have already got there in the beginning. There are going to be instances where you're going to want to cut right to this slide, and that may be right where you're at right now. Okay. And I'm going to lay out some scenarios where that could definitely be the case. The most common ones that I see. So the other side is preparing a conclusion of value and testimony right now. This case is landed on their desk, and they're already going forward with this. They hired a smart expert with a good reputation. Another indicator that settling may be off the table. The business has value, and there's big money at stake. We've gone through our flow chart. We know that the business has value, and it's substantial. They won't negotiate. They won't take our calls. They won't take our meetings. It's not happening. And this is not designed to be a joke. I mean, as you attorneys live this every day, the business has no value, but they're going to court anyway, right? And some people are just irrational. So what I would encourage you to do is prepare for worst case scenarios. Don't wait. If you think it's headed in that direction, you do not want to run out of time for a conclusion of value and testimony preparation. If you think it's headed that way. So let's summarize here, and I'll keep you running on time. Leave a little time open for questions if anybody wants to ask me anything after or during the session or on another day when you have more time. Get answers to the three questions. I think that's going to lead you on the best path to help your client. Again, going back to, is the juice worth the squeeze? That's that's the question I hear in my head when an attorney calls me. Those answers will tell you if the business has value. If it doesn't have value, consider settling or walking away. If it does, consider a calculation of value for settlement first. It may not be in the cards. We went through the landmine section and the other side, not interested in settling. That could be a case, but if it's on the table, I would consider that. Watch the discovery issue, and for obvious reasons, because you could end up with a report later that has a different answer if you go into court. Okay. So just be mindful of that. If it can't be settled, consider a conclusion of value for court and prepare for those worst case scenarios, because some people are definitely irrational. I really appreciate your time today. Thank you very much for everybody that spent their very valuable time doing this. As I said, I think this is the third time I've said it. I will get this. This is recorded. I will get it polished up a little, probably using some editing software to get rid of any time lags and those kinds of things, and get you a link if you want it. And I'll probably put it on my YouTube channel so that anybody can access it if you want to. I'll leave it open for chat questions if you want. If you need to get a bite to eat instead, that's cool too. And you can reach me at this contact information here. And I look forward to talking to you again. My name's Josh Horn, and I'm with Horn Valuation. And I hope you have a great day. Thank you.